Good evening. Welcome to the KU Alumni Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Thank you so much for participating in tonight's class. We're excited to be able to bring some of this content to you to help you learn a little bit about homeownership and what could look like for you on your journey towards achieving that financial goal. This is a class we produce for the KU alum 4 times a year. So we offer this once a quarter. And so we provide these resources to really help provide you some different tools to really what's going to be probably one of the biggest financial decisions you decide to make. So we're glad you could join us for tonight's class. We're going to dive in just a second. I'm going to allow everybody to get into the Zoom session. This will be a very interactive session. So as I go through tonight's content, encourage you to ask questions of me as well as my colleague Ken Fleck, who's joining the class as well. So any questions that you guys have, we'd love to be able to help answer them for you in tonight's session. Our run time for tonight will put us up to a run session of just about an hour or so. And then what we'll do is we'll be able to kind of weave in some questions for you in tonight's class. Let me just make sure we're good on our screen share. And we're good now. So, okay, well, let's dive in. By the way, all of the presentation material from tonight, we're going to share back out with you. We're going to provide the links to all the resources we provide you in tonight's class, as well as a link to the video from tonight's session. So we're going to record this, have this up on our YouTube channel. So if you want to look back at that, you can go ahead and do so. We always obviously encourage you to take some notes in tonight's class, but if you'd like to look back at some of the material, we'll provide you all those resources as well. Well, my name is Jason Maida. I'm going to be your presenter this evening. I love to be able to help provide valuable tools like this for our local communities that we serve all across the country. I know most of our alum might be based out of the Midwest, but we're a nationally based company. And our team in particular focuses on really providing educational tools in home ownership, specifically around first-time buyer programs and different tools that are out there and available to help you on this journey towards home ownership. So our relationship with many of our clients start in a learning session like this. So it's kind of a learning environment. We can help kind of train you up on home ownership. And then you'll hear more about our consultative process. So after tonight's class, love to be able to get connected with you for a free consultation to help really design some customized home buying options for yourself. Well, as I mentioned, tonight's class is going to be very interactive. So these are some of the talking points for this evening. We'll spend some time looking at the housing market as well as what's happening with interest rates. Finally got some good news coming off the 3-day weekend with interest rates. So I'll kind of share with you a little bit more about some market data, what's happening there. We're also going to walk through a rent versus buying calculator. So we're going to look at comparing going down the path and continuing renting versus what could look like if you decide to purchase a home and some of the tax benefits that come along with that. We'll also spend some time looking at credit. I'll kind of dive into the mortgage model for credit, show you maybe areas of opportunity that you might be able to take away for your own personalized credit score. We'll also outline some different loan programs that are available to you, as well as first-time buyer programs. Talk a little bit about savings for home ownership. That tends to be one of our larger challenges for some of our clients. So I'm going to walk you through how you can plan for home ownership and save enough to be able to meet those goals. And then we'll talk about the buying process. That's going to be in the latter stages of tonight's class, but it's probably one of the most important things is really to understand what you're going to experience as a buyer. So after you leave tonight's class, hopefully you have a couple key takeaways for yourself, but I would love to be able to kind of show you what it's going to look like on your journey forward towards home ownership. And again, we'll talk more about our consultation process. All right, so that's our plan for tonight. Love to be able to share this with you. So let's go ahead and dive in and we'll launch into our first topic, which is, does buying really make sense for me? And like I said, this is a big financial decision for you. And so the fact that you're spending, your Tuesday evening just after a 3-day weekend to kind of learn about home ownership, obviously kind of shows the importance that you guys have in really understanding more about what this journey could look like for you. When you think about home ownership, there's some really key benefits that play a role in home ownership. Things like affordability, and that's a challenge in most parts of the country. When you're a homeowner, you're able to kind of control your budget a little bit more. You're not, at the mercy of a landlord that's increasing your rent because now you have a fixed payment for your home mortgage as well as taxes and insurance. This is also an asset that can also work for you. So as that home goes up in value, the difference between the home value and the mortgage balance is called equity. And for most of us that are homeowners, equity in our home is probably our number one asset that we have, and it really can be transformational for us. It can have the opportunity to create generational wealth for families. So it can be a huge, huge, huge game changer for you. There's also tax benefits that come along with owning a home, potential tax deductibility of mortgage interest, as well as when you decide to make energy efficient, maybe improvements to your home, that can also create a tax benefit for you as a homeowner. Now, a lot of times when I talk with clients, they don't really realize the magnitude of home ownership and how it really can change their lives financially. And so one of the things we like to do in our classes is to go through one of our tools that's available. It's called our rent versus buying calculator. And what that calculator does is it frames up a side-by-side comparison of going down that same path of renting today versus if you kind of side-by-side compared it to home ownership, what could it look like for you? And I took some time before tonight's class just to kind of pre-fill out this calculator that's available on our site. There's also some other great tools out there like affordability. One day, if you're a homeowner, you might think about refinancing. So that's a great calculator to take a peek at. And then, of course, just your payments for your overall budget or home ownership. So a lot of great tools that you can use to prepare yourself. Let's kind of walk through this calculator really quick. I think it'd be helpful to kind of frame things up for you. Let's make the assumption that we're going to buy a home, let's say at $300,000, right? Well, the minimum down payment for a first-time home buyer with a $300,000 purchase price is 3% of the purchase price, or of course, $9,000. So that would be my down payment that I have to have into the mix for home ownership. And then, of course, I have my first mortgage amount, which is noted here. We put an average interest rate somewhere between 6.5 to 6.6, depending on credit score and loan structure. We have the fact that we'll do a 30-year fixed mortgage. We have an assumption that this buyer is going to purchase sometime in July. That won't really change things much, but just to give a kind of a target date. We have PMI, or also known as private mortgage insurance. We'll spend some time talking about that this evening, but ultimately private mortgage insurance will be based upon what our down payment, credit score, and amount financed looks like. We have homeowners insurance. We have property taxes that are part of the home buying equation. So that's all kind of on the home mortgage side of things, right? Now, maybe I'm deciding to buy a condo, maybe a townhouse, then we want to factor in HOA dues into our budget calculation. The other assumptions that we want to look at, and we don't always think about this when we're thinking about home ownership, is like, what tax bracket am I going to be at? That's where I could potentially create tax savings for myself. What are some of the maintenance costs of upkeep for my home? What are the selling costs going to look like? So if I eventually decide to sell my home, what are some of the expenses that I'm going to pay in conjunction with the sale of the home? And then, of course, appreciation in my home. Now, different markets will appreciate at different rate levels, but ultimately, this should be an asset that for you that appreciates over time. Let's face it, real estate does cycle, but hopefully, as you see seasons in your home, you'll be able to realize strong appreciation rates. And then that's all in our home ownership column of this analysis. Other side of things is the rent side of things. So let's assume we're paying $1,500 a month in rent. Our renter's insurance is 1.3% of that amount. So somewhere in, probably the $30, $40 a month range. We also have rent appreciation, meaning how much our rent's going to go up on an annual basis. And most landlords, because of cost of living, are starting to raise rents and obviously challenging affordability. So that's on the rent side of things. And so what our calculation does is it says, okay, if I go ahead and purchase that $300,000 home, I start realizing the benefits of home ownership versus continue to pay rent. My break-even point of the expenses that I'm putting into my home ownership plan versus my rental plan is about a 3-year break-even. And so what that means is I'm going to turn a profit in home ownership in 3 years. And for our clients that I counsel to home ownership, we generally want to see a break even in 4 years or less. So that's really the goal. This scenario would certainly pencil out for a client. Now, that's just the break even point. Now, where it gets a little bit more interesting is if we span out a further or a longer period of time, right? At 7 years, if I was to own versus rent, now I'm $37,000 on the plus side. That gets a little more exciting. Now, if I start looking at maybe 10 years out, let's take our little span out 10 years. Now we're looking at like a $75,000 opportunity of owning versus renting. So I think, those are ways that we can help kind of think through homeownership a little bit better when we have calculators like this. That's just one example for our class tonight to kind of launch us into our discussion. I would encourage you to do some research on your own with these calculators. put in some different numbers of communities that you think you'd be taking a look at, and that'll help kind of, help you, like I said, think through homeownership a little bit more. I'm certainly will be a partner for you in that journey if you decide to do a consultation with us, because I really want to make sure you understand the upside benefits of homeownership. Now, our entry into homeownership also depends on what's happening in the housing market, right? We got to make sure there's options out there that we like, communities that we would want to consider moving to. If we were to look specifically at the Kansas housing market, right now the median sales price across Kansas is just over $300,000. 30 days or 34 days is the median days on market, pretty much in line with most parts of the country. Of course, affordability, Kansas is probably one of the more affordable markets in the country. I think as we're looking at the prices, though, it's interesting. We're starting to see, some price gain here. So sales are up 12% year over year. Prices are up 7.1% year over year. So, I think that's a really positive move for the Kansas market. Let's face it, many clients that I work with all across the country are looking for affordable options. And so, a state like Kansas or some of our other Midwest markets that we support can be great options for first-time buyers to get into the housing market. Now, right now we're in the spring and going into the summer buying season. That's traditionally when we see more activity pick up for buyers. Even though right now in kind of the economic environment we're in, there still is a lot of buyer activity out there in the market. Now, many buyers are kind of hinging on to what's going to happen with interest rates, and that can maybe sway their buying behavior. But I think, even with kind of an, incline in interest rates as of late, we're still seeing a lot of buyers starting to really re-engage in the market. The challenge we have in most parts of the country is just not a lot of inventory to support the buyer demands that we have in today's marketplace. Now, there are 4 states that have the highest level of supply in the market, and that's Texas, that's Colorado, that's Georgia. And so we're seeing a lot of those markets, Florida is the 4th state. We're seeing those markets have some of the best supply out there, and those are truly buyers markets. So if anyone attending tonight's class interested in those states, that's certainly a buyer's market. Now, interest rates, like I said, those will sway the buyer behaviors. And, we've been kind of all over the board with interest rates, especially over the last 12 months. Unfortunately, with the conflict in the Middle East, that is really putting a bit of a cloud over the economic markets, including interest rates. And we've seen interest rates make a pretty big move upwards. You can see as the conflict arose, you can see this is kind of where the 30-year fixed rate started to rise. And it actually peaked out 60 days after that, after the war broke out. And so, we hit our highest of about 6.6, 6.75. We touched down just early last week. Then, of course, there's been a reversal of fortune. If we were to take this graph out and kind of push out further, now we saw rates now started to come back down, all in anticipation of that there might be a resolution to the conflict. And so, I've never thought I would have to kind of manage through what's happening with oil prices, but oil prices are really driving a lot of the activity in today's market. So, we're watching that really carefully. It's our job to kind of counsel our clients and try to make sure that we're trying to grab the lowest rate opportunity, but this market remains quite volatile. And so, as we're coaching clients that are actively under contract with the seller, we're trying to find these little windows of opportunity to seize the lowest rate environment. To kind of paint the picture a little bit more, I'm going to go off script a little bit and share with you one of the dashboards that I use in counseling clients that kind of gives me real-time market data. This is another picture of what we call mortgage-backed security prices or mortgage bonds. The lower this chart goes down this way, the higher interest rates go. So this is what we saw on May 19th, the highest levels we've experienced in 12 months. But it switched, right? So we're going into the 3-day weekend, we had a nice little improvement. And then today we have even more improvement. So unfortunately, it's just this really roller coaster ride of interest rates. I think as I counsel clients on where they're at with their particular own situation with their finances, I think it's important to understand that those that choose to buy in today's market, this isn't probably going to be your forever loan. It's probably something that we're going to enter into the housing market for the next couple of years. And then as interest rates start to drift over time, then we're going to try to seize opportunities for refinancing. Also, interest rates are not the same for all clients. So that's important. Just because maybe your colleague achieved this interest rate back in 2020 or 2021 doesn't mean that interest rate is going to be available to you today or even just last year. Different factors go into interest rates like credit score and eligibility, the type of program I'm going to use, how much I decide to finance, what my down payment looks like. You also have the option, which I have a lot of conversations around this, it's called buying points, or basically paying additional costs out of pocket in order to bring down your interest rate. Not necessarily something that I would recommend doing because investments in points have about a 4-year break-even point on them. So as I just mentioned, we're probably going to consider refinancing a couple years if we buy in today's market. So we don't really want to invest a lot of money in points unless it's being provided through maybe seller credits that are available, or I just have to achieve a certain payment level because of kind of where my budget looks like. Also, loan term can also impact the interest rate offering, because the shorter my term is, the lower my potential interest rate opportunity will be. You've heard me mention this a few times, but ultimately we're going to customize options for you during our consultative process. So I'm going to work with you one-on-one to talk through different budget scenarios and prices and out-of-pocket expenses to see really how we can best tailor your own home buying plan. All right, well, as we kind of meet with our clients and especially in a learning environment like this, we want to talk through credit a little bit because we want to identify areas of opportunity with credit to help really maximize your credit score, to help decrease your borrowing costs. Every loan program does have a minimum credit score as the entry point. And we put those products on screen here so you can kind of see the minimum credit scores. Now, there are 3 different models to credit scoring. There's the credit card model, which is going to show up in most of your consumer monitoring that you guys elect. There's also the auto financing model if you're going run out and buying a car. And then, of course, there's the mortgage model that we use in home financing. So those different models will have different variations of scores. So you may look like 750 on your credit monitoring that you get from Credit Karma, but maybe your mortgage score is at 740. And I'm going to show you why that is in just a second when we go through the score modeling of, or the score weighting, I should say, for the mortgage score. Now, if you've had challenges in the most recent, let's say 12 to 24 months, that's when you're going to see bigger impacts to your credit score. But if you've haven't had any late payments, then there might be some other areas of opportunity that we can identify in the credit score model. But if you've had late challenges or over limits in the last 12 to 24 months, that's going to be the most impactful to your score. Now, there's 3 different agencies to scoring. There's Equifax, there's TransUnion, and then there's Experian. So each of them have different models that they represent in their scores. And in lending, we always take the middle credit score of all 3 scores. So if your highest score is 780, your middle score is 760, and let's say your lowest score is 740, well, we're going to take that 760 as your middle score for qualifying purposes. Now, if your spouse is going to join you or partner is going to join you and they have a 740 score, it's 20 points lower than your score. We're going to take that 740 score when it comes to qualifying for your mortgage, because we always take the lowest middle credit score for each borrower. Now, when we think about maybe some legacy items on our credit report, maybe past challenges, collections, late payments, whatever the case may be, I wanted to pass along this matrix to you that kind of shows you how long they'll stay with you on your credit report. Now, the impact is in the most recent 12 to 24 months that they'll be on your credit report, or that they'll impact your score, I should say, but this is how long they'll stay with you on your credit file. So if you're anticipating something falling off your credit report or whatever, that gives you a timeline of how long that negative item will stay with you on your credit report. Now, this is what the mortgage model looks like for credit scoring. I'm going to walk us through each one of the weightings because my goal is for you in class to maybe identify an area of opportunity for your own personal credit score, so you can help see some areas of opportunity to help lift that score. Because when we think about lending, the difference of a 720 score to a 760 score can be a massive difference from an interest rate perspective, as well as maybe a mortgage insurance standpoint. So when we look at the score calculation, 15% in this part of the score modeling here is going to be how long have I had credit open. So the more mature my credit file is, probably the higher my credit score is going to be. So if I just opened up 3 new accounts and that's what I've had over the last 12 months, that's it for my credit history, that might project a lower credit score than, say, someone that's had those same number of accounts for the last 3 or 4 years. Now, there's a little bit of a balance to opening credit because you don't want to open up too much credit, because 20% of the model is how much new credit am I trying to access. So we really want to be diligent and be mindful of how many accounts we're opening up, especially in the most recent 12 months. You really want to avoid hard inquiries on your credit because hard inquiries can have a negative impact to your score. Our process is a little bit different with APM. We only start with a soft credit check in evaluating options for our clients for pre-approval. The reason why we do that is because many of our clients that I work with are maybe on longer cycle times for purchasing a home. It could be a year goal, it could be a 2-year goal. Now, we want to provide you all those tools and resources without impacting your score. And that's why we start with that soft credit check. Next spot to look at is how much I owe in my revolving accounts. So we also call that utilization of credit, looking at how much of your credit limits that you're participating in that are accessing those credit limits through the current balances. So we really want to make sure that we're aware of that. Now, credit utilization can be probably one of the biggest drivers of your credit score, other than obviously payment history. If I'm in a situation today, and let's say I have $10,000 in credit limits and my balances are $5,000, right now I'm at 50% utilization of credit. Now, our score is probably okay at that level, but what I would encourage our clients to do is let's try to get that credit balance down to 30% utilization and ultimately reach to 10% utilization or less, because then I'm going to really get the uptick in my credit score. Now, when credit card companies report out your information to the credit bureaus, they report it at the end of the billing cycle date. So my tip for our class tonight is try to pay down your credit cards before the end of the billing cycle date. Try to pay them off or pay them down, whatever you can manage. And that ultimately will produce a lower utilization level and a higher credit score. Last section is payment history. That's pretty self-explanatory, right? We're looking at how have we paid our bills, again, especially in the most recent 12 to 24 months. If I've had late payments, they're going to be rated as 30-day lates, 60-day lates, or 90-day delinquencies. The more severe my late payment is, bigger impact I'm going to have to my credit score. Now, one of the counts that shows up on credit scoring is going to be student loans. And I have a lot of conversations, probably on a daily basis, with clients about their student loans, how we interpret them in the lending process. Whether you're in public forgiveness for 10 years of student loans that are going to fall off, whether you're in a forbearance, a deferment, or in active repayment, we have to evaluate student loans if they show up on your credit report as part of the lending process. Now, if you're in forbearance or deferment and don't intend to have an enrollment in a payment plan anytime soon, then by default, we take 1% of the balances as your monthly payment for, let's say, a conventional loan. For an FHA government insured loan, we take 0.5%. And you can see those calculations on screen here. So if I had $75,000 in debt, then we're going to use $375 as a payment for an FHA loan, $750 for a conventional loan. I know many of the federal student loans are starting repayment in July or just shortly after. So if you're thinking about purchasing a home relatively soon, it's probably not a bad idea to sign up for repayment, especially if you can get in a manageable income-based repayment program, because then we can use that payment in calculating your, what we call debt to income ratio. So if you had $75,000 worth of student loan debt and you just signed up for a savings plan at $250 per month, well, then that's the payment we can actually use for qualifying purposes. So I'll help talk you through student loans if those are something that's, in your financial profile. I always encourage clients, don't let student loans hold you back from home ownership, whether you have $50,000 in student loan debt or $100,000 in student loan debt. I think it's just something we have to kind of talk through and how that kind of folds into your plan for home ownership. All right, now we're going to dive into loan programs. Before I do that, I just want to kind of open up for the audience. I forgot to mention that I am going to take questions as we go through tonight's presentation. You can use the chat function. I'll be monitoring that window as well as the Q&A function in Zoom. So feel free to drop any questions you have in one of those two areas of Zoom. If not, I'll carve out some time at the end of tonight's class too to follow up any questions. And certainly I'm available offline for any questions on customized situations that you have. All right, well, let's talk a little bit about loan programs. And I'm going to give you a little bit of high-level look at loan programs. And we're going to talk about these 5 core programs that we have on screen. You probably heard much of this terminology in maybe some of your searches or just kind of hearing from colleagues or friends or family. The first loan we're going to look at is called a conventional home loan, which is going to be centered around Fannie Mae and Freddie Mac. That terminology or those names came up quite a bit during the housing crisis. Each one of those agencies offers a 3% down program for first-time buyers, up to the conforming loan limit, which is $832,750. And so anywhere in the country, I can buy a home with as little as 3% down. And as we'll talk about a little bit later, there's first-time buyer programs that will help supplement that 3% down. The next product is an FHA loan. FHA loans are government insured loans. So there's requirements on the FHA loan, a little bit lesser credit score requirement with FHA. That maximum loan amount that you see on screen will vary based upon where in the country or county that you want to make your purchase in. FHA will tend to have a little bit more flexibility in guidelines, whether that's credit score qualifying or expenses to income ratios than we will see in a conventional product. Now, both FHA noted here and USDA are both, like I said, government insured products. There were some changes last year, which would also change the residency status requirements for both of those products. It does require you to be a permanent resident to access either FHA or USDA. However, conventional loans have not changed that residency requirement. So if I am a non-permanent resident, I can still get access to the Fannie Mae or Freddie Mac resources for home ownership. Now, we'll talk about USDA since we're kind of on the same topic. USDA is designed for more rural purchases. So if I'm going to look at a more rural area, lesser populated, I can utilize USDA, which is essentially 100% financing. Same scores generally as USDA. It'll go to the lower score levels. But there are two requirements. The location of the property has to meet USDA, and we'll also consider the income for the total household to be eligible for that product. But really, the benefit with USDA, it's a zero down payment option. The jumbo loan is off to the side here. It is certainly a tool available to us, but it's really going to be designed for clients that have to purchase at higher levels. A lot of our high cost of living areas that maybe don't have the support from like a conventional loan. It also does come with it higher down payment requirements, 10 to 15% down payment, and slightly higher credit score requirements. What I don't have on screen is our physician's loan too. That's a tool that we can use to help out, folks that have just got out of residency or not actively practicing. Maybe they have a significant amount of student loans. A physician's loan can allow us to be able to qualify a client with not having the burden of that student loan debt, a little bit more favorable terms to help the physician's entry to home ownership. So if you're interested in a product like that, just let me know and we can have that conversation and see how that fits into your plan for home ownership. The last product noted here is our VA home loan. So for our veterans that have have eligibility for that product, it does provide the veteran a zero down payment option, lower minimum credit score requirements, a lot more flexibility in the underwriting guidelines than other products. And there really is no maximum VA loan amount. Okay. So that's kind of a look at the high level view of the different product options. Now, a conversation I have with clients, whether it's in class or it's just in your one-on-one consultation, is to talk about mortgage insurance. And just to kind of explain a little bit more, I want to kind of give you a few different examples as it relates to mortgage insurance for a conventional loan, so Fannie Mae, Freddie Mac, as well as the FHA government insured loan and what those look like for you. Now, PMI is essentially insurance that protects the lender against default. So if I had an economic hardship, I was unable to make my payments on my mortgage, the PMI would essentially support the lender as insurance. Now, it is always consumer paid for the most part. When we look at the conventional PMI is based upon your down payment, credit score, and how much I finance. So if I can, make a higher down payment, I can raise my credit score, like I mentioned earlier during our session on credit, then I'm going to help to reduce the outlay of my premium for conventional mortgage insurance. Now, there also is a cancellation option with PMI on a conventional loan. So once I reach 2 years in my loan and I have 20 to 22% equity, I can apply to have my mortgage insurance canceled. Here's an example of PMI down here at the bottom of the screen with someone buying a $300,000 loan, 3% down with a 740 credit score. So it's not a significant amount. Certainly, it's something that we want to, take into consideration as we build our budget. But if you've started your searches on maybe Redfin, perhaps Zillow, you're probably coming up with a lot higher mortgage insurance number. So that kind of gives you a sense of what that cost might look like for you. Next product, or kind of just a side-by-side compare that, is MIP, or mortgage insurance premium, for the FHA loan product. Now with MIP, that insurance is a little bit different under the government insurance umbrella because there's monthly mortgage insurance, which is the equivalent of 0.55% of my loan amount. Then we divide that by 12 to come up with a dollar figure monthly. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. That gets rolled into my total amount financed. Now, there is no cancellation option for FHA mortgage insurance. So that can tend to be one of the drawbacks for FHA mortgage insurance. So, it's really important for us to be careful in kind of how we structure things and talk more about long-term goals around home ownership too. I look at FHA as kind of more of the short-term solution for most of our clients because FHA will give us a little bit more flexibility in how we qualify our clients, whether that's expense ratios, whether that's the down payment amount, or that could just be around credit score. Here's the example of the payment scenario for FHA you can see on screen. So that upfront mortgage insurance adds about $5,200 on top of the balance. So that can be significant. And of course, the monthly amount is a little bit higher. But the mortgage insurance is kind of a one size fits all with FHA. Whether I'm a 680 credit score or a 580 credit score, the mortgage insurance will be exactly the same. Now, I had a question that came in from our audience, and so I'll just kind of read it out to the group. If you can qualify for a conventional loan, is there any advantage to going with an FHA loan? Really, the answer is no. If I can get into the conventional product, I certainly would go that route. That brings up a good question too, Zach, because I get a lot of clients that look at the FHA interest rates online and say, well, Jason, I want to go into an FHA loan because the rate's a lot lower. It's like 0.25% or 0.5% lower. That is true. But when you factor in upfront mortgage insurance, when in the scenario that we're looking at, plus you have higher monthly mortgage insurance, it really cancels out any benefits of a lower interest rate. And let's face it, we want to have also the option to cancel mortgage insurance at some point in time. So I do find that some lenders like to present the FHA opportunity first for clients, but not giving clients the option of the conventional mortgage insurance, the conventional 3% down option. So I certainly would go with conventional if we can certainly make that work. Again, we'll have that conversation too during your session with me to kind of figure out the right direction for us with our plan. All right, thanks for that question. I want to talk a little bit about qualifying income just really quick. And then we'll kind of spend some time looking at our savings plan and then kind of wrap up tonight's session with our buying process. So let's talk a little bit about income and provide you the documentation list here. This is some of the needed items when it comes to starting the qualifying process for home financing. Really easy to do, simple documents you can upload at any time. Now, in scenarios for income, I like to kind of share that back with our class to just kind of dispel some myths, if you will, around homeownership. The way it works in lending, you do have to have a 2-year employment or educational history documented on your application. So that could be 1 month on the job, and because I just graduated from KU in the fall and I just started this year, or it could be I just started my new job and I've been in the workforce for the last 3 years. Regardless of that scenario, we're going to have to just put together 2 years of work history and or education. So you don't necessarily have to be on the job a certain amount of time to have eligibility around homeownership. I've had conversations with clients that are getting ready to start a new job and haven't quite started yet, but they do have an offer letter and want to get qualified for their mortgage. You can qualify for a home financing and in some cases close escrow on your home with as simple as an offer letter. Now, the 2-year requirement plays a role for self-employed individuals. We have to show a 2-year history for self-employed individuals. They have to have at least a 2-year tax filing time period. So we have to show that they've been consistently filing taxes for the last 2 years. Okay, so that gets factored into the equation. If you are in a variable compensation position, like you have a base salary, plus you get bonuses that are annual or quarterly or monthly bonuses, if you want to include variable sources of income into your home buying plan, then we have to show that you've been on both jobs, or sorry, on your job, not both jobs, but on the job for at least 2 years. Now, if you have dual employment, that's kind of where I was going with this. Like you work for 2 different employers, then in that case, if you want both sources of income counted into your qualifying, you have to show that you've been on both jobs simultaneously for the last 2 years. All right. So things like overtime, bonuses, commissions, all that stuff. Generally, we want to have to see that we have to be on the job for at least 2 years. If I also work for Uber on the weekends or DoorDash, whatever the case may be, if I do want to count that income into my qualifying for my home mortgage along with my full-time job, then I have to show that I've been on both jobs for 2 years. All right. So that's kind of some of the scenarios that we come up with. And last thing I just wanted to share back with our class is that if you have, let's say, a spouse or a partner that wants to or is currently contributing to the household income, but is electing not to be on the mortgage application, the only way we can count their income is if they're actually on the application for qualifying purposes. All right. Now, one of the things we take a look at is income versus expenses, and we call that calculation debt to income ratio. It's one of the qualifying metrics we use in lending. doesn't necessarily dictate affordability, because you may qualify at a higher debt to income ratio, but your affordability needs to be at a certain level here, right? Affordability is something that you and I are going to have a conversation about during your consultation to make sure we're designing options that can help you meet the mark financially for yourself. So it's not a stress in home ownership. A sustainable home ownership is important to us as well as affordable home ownership. And on this calculation of debt to income ratio, we're looking at the principal and interest, the taxes on your new home, the homeowner's insurance. If you're paying mortgage insurance, we'll factor that into the calculation, along with maybe HOA dues if you're buying a condo or townhouse. So we look at that in our calculation, but we also take into consideration your current debts that you might have, maybe a student loan, a credit card, a car loan. So I have the calculation example on screen. So we have someone that, let's say, has $2,500 in expenses for the new mortgage, $500 in other debts, and they make $8,500 a month. Well, the debt to income ratio calculation would tell us that the payments that we're going to have with this projected housing scenario will consume 35.3% of the pre-tax income. And that's, what I would consider in kind of the comfort zone for most clients. Usually clients that have 33 to 36% of their expenses or their income going to expenses feel pretty comfortable, like that's an affordable plan. Others feel like they need to be at 24% or 25%, but generally 33 to 36% is a good range for clients. The maximum we can go is 50%. So that's when we start getting into the top end of the qualifying limits for any type of product. FHA will allow you to go a little bit higher than that. But as we kind of figure out your plan for home ownership, you may only be able to document a certain amount of income because maybe your partner's not going to be on the application. So that might push up your debt to income ratio a little bit. So we'll talk through different scenarios for you as we build your plan around home ownership. Last thing we want to talk about in building that plan before we talk about workflow to home ownership is the down payment. And for most clients, that can be one of the bigger challenges, if you will. Just saving up for home ownership, whether we're just out of school and we're trying to figure out student loan debt and other payments and just kind of getting off in our careers. We're just trying to figure that all out. And so savings might be a little bit challenging. So I'm going to walk you through a savings plan to prepare you for home ownership in just a minute. But I did want to point out to you the resources that you could pull from today if you think you're in a good position to pursue home ownership. Obviously, checking and savings accounts can be used. We can't use cash because cash is not acceptable, but the assets that we use have to be seasoned for at least 60 days. Retirement accounts can be used, 401ks. Some clients will have 403bs, savings plans through government agencies. Those all can be used. Brokerage accounts, I would just encourage you before you access assets like that, please check with your financial or tax advisor to make sure it's a good financial move for you. Gift funds can also be used. That's where a family member is contributing towards your home purchase. Now, there is no seasoning requirements for gift funds. There's just a documentation process. You have to verify where they've got the funds from and just kind of provide proof of the tracking of the funds. All right. So this is over here is our savings plan for home ownership. And it's a very simple approach. But we want to look at where I'm at today and where I want to go with home ownership. And then how do I close the gap with what I have available in assets? So if today I have $1,500 in rental expense, but in my career with my job right now, I think I can get to a $3,000 mortgage payment. I'm just, where I'm short is I don't have enough for my minimum down payment. So my coaching for our clients would be, let's start saving like I'm paying a $3,000 mortgage payment today. So the first of the month comes, June 1st rolls around. I'm prepared to not only pay my $1,500 rent payment, but I'm also going to create that discipline for myself that another $1,500 goes right to my savings account. Maybe it's a high yield savings account. And I'm doing that repetitiously month in, month out. And I start to see my savings balance grow. And I'm getting some interest payments from that as well, too. So by the end of 6 months, maybe I have $9,000 in there. By the end of a year, I have $18,000. And now as we looked at some of our payment scenarios and mortgage calculations, like that could potentially get us to home ownership and maybe also participate in first-time buyer programs. So it's a very simple approach to savings, but I think it's a really effective one that can help really close the gap on where our today situation looks like versus what our tomorrow projections look like in home ownership. Now, first-time buyer programs can also help close the gap as well. In Kansas, we have the Housing Resources Corporation, which can provide up to 15 to 20% in assistance for down payment. There are income limits for this program. It's forgivable after 10 years, but it's only available in certain parts of Kansas. So we can talk offline for your own home buying plan and see if you meet some of the markets that can be considered for the Housing Resources Program. We also have the Pathway DPA program. That's an internal APM program, can provide anywhere between 3.5% to 5% in assistance funds, but it only is compatible with an FHA loan. So that might be something to consider. And, in fact, we have some of our KU alum that are using this product right now, which is the 1% down APM mortgage program. What's nice about this program, it provides support for the buyer that's looking to do a 3% down option. So if you contribute 1% down payment, APM will match you the 2% to make up the 3%, and it's a grant that we provide. Now, you do have to make less than 80% of the median income to qualify for the 1% program, but that's a fantastic tool that you can use to purchase using a conventional loan. Now, in class, you may not be looking in the Kansas market, and that's totally fine. We can support you all across the country. Every state has some variation of a first-time buyer program. The income limits will change based upon that market, but there's certainly resources out there for you, whether in Florida, Georgia, Texas, California, Colorado, whatever the case may be. There is some type of resource for you, and we'll make sure that we can plug you into some of that, some of those tools if that's something that you have interest in. All right, we're rounding the finish line in tonight's class, and I want everybody to hang in there with me because I want to walk you through the 6 steps of the home buying process. I get a lot of questions on where do I go from here, especially after we attend a class. And so you've heard me mention a few times, I'd love to be able to get connected with you for our free consultative service where we can meet virtually for 30 minutes to design a plan for you around homeownership. Whether you're going to buy this weekend or 3 years from now, we want to just be a partner with you in achieving your financial goals. Now, that session will have an output, and the output could be, hey, we got to put a savings plan together. We might need to work on some credit, or we might be ready to go and say, okay, we're pre-approved. Doesn't mean we have to go buy a house today, but that pre-approval shows you your baseline of eligibility. The pre-approval is good for 60 days, but it can be always recertified at any time. We will tailor that pre-approval to match your home search. And so when you're ready to go out into the market, whether that's looking online, whether that's looking in person, you will be financially equipped to be able to, kind of seize that opportunity that you might see in the market. At step 2, that is that house hunting phase of the process. We would encourage you get connected with a local realtor that knows your community that you're considering. If you want a recommendation of a trusted resource in our preferred network, I'm more than happy to connect you. But I always encourage clients to have a realtor that can support them in that house hunting phase. Now, I get this question all the time, which is how long is it going to take me to purchase a home? Well, I always go back and say, well, it's probably going to be in that step 2 scenario where how long it's going to take me is based upon how long my search is. Because I may want to be in a certain school district for my family. I might want to be in a certain community because it fits my lifestyle, whatever the case may be. Step 2 is probably going to be the longest phase of the process. That could be 2 months, 2 weeks, maybe 2 years. Now, when we do identify that right property, let's say, we found the right home, we're going to work with our realtor to structure an offer. That'll be all tailored to the specifications of what you want to present to the seller. If the seller accepts your offer, then you move to step 3, and that's called entering escrow in most parts of the country. It just basically means that you and the seller have come to terms and said, hey, yeah, I'm going to purchase this home. I'm going to close escrow on July 15th. That means that I get possession of the home July 15th. And it kind of really sets in motion what's to come in the processing of your financing. Now, generally speaking, to go from step 3 to what you'll see as step 6, traditionally it takes about 30 days in most parts of the country. Some markets that are super competitive, it could be as short as 14 days. Now, once I get alerted of your accepted offer, I'm gonna reach out to you and say, hey, congratulations, you did it, your offer is accepted. I'm going to walk you through some next step items of what your action items would be. Things like making a deposit on your house, which is usually 1% to 2% of your purchase price. We'll schedule you for a virtual session so we can review all your financing elements, and then it kind of kickstarts the processing of the loan. Now, some of your action items as a buyer, like I mentioned, is this earnest money deposit. The earnest money deposit is 1% to 2% of your purchase price. That will count towards your total out-of-pocket, which out-of-pocket means down payment, closing costs, and what we call prepaid items to purchase your home. Now, in most parts of the country, the real estate purchase contract has what we call as contingencies as part of the contract. Those contingencies give us protections as a consumer to do some investigative work to make sure the property is the right fit for us. whether that's the appraisal to make sure the house is worth what we're purchasing it for, inspections of the house, getting our loan approved. That will all come in within a timeline of contingencies. It can be as short as 7 days. Sometimes it's as long as 21 or 30 days for that contingency period. Now, as we kind of move through this workflow, step four, I should say, takes us through the administrative side of the financing, verifying your employment, assets. We'll have some requests that come to you to get us prepared for underwriting. And we have a note here about rate lock disclosures. And, rates vary by the minute during the trading day. And so once you're under contract with the seller at step 3, now we're going to have strategic conversations on timing of locking in the interest rate. You heard me talk about interest rates earlier today. A lot of volatility in the markets, but there will be windows of opportunity like today to be able to seize lower opportunities. And so that's why we want to make sure that we're really connected with you to try to jump on the lowest rate option that we can obtain for you in the market. Because we have kind of constraints, if you will, based upon the close of escrow time period. So if you're supposed to close escrow on July 15th, we got to make sure that your interest rate is locked no later than probably a week or 2 weeks before that scheduled escrow closing. But we might need to lock things in 3 or 4 weeks before because maybe the market is creating that volatility. I mentioned, again, part of our process, we're going to do a follow-up video session with you after you go under contract within 2 to 3 days to go through all the details of your financing, that interest rate strategy talk that we're going to have. We're going to talk about payments, out-of-pocket expenses, and just make sure everything is fine-tuned for you in your financing. Step 5 is going to be your loan approval phase. That means we got the appraisal back, underwriting decision is back. You probably have your interest rate locked in by that time as well, too. You're going to be getting variations of disclosures sent out to you through the process. There's your initial disclosures after our follow-up video session. Once we lock in your rate, you get another disclosure. And then finally, at step 5, we send out your 3-day cooling off period, which essentially gives you a 3-day waiting period before you sign final loan documents in person with a public notary or maybe an attorney, depending on what state you're in. That day on step 6, we'll be signing final loan documents. We'll be also wiring in the final funds for our closing. If I'm in, say, Kansas or maybe Texas, those are an example of what we call as table funding states. The date we sign documents is the date we fund your loan, and we close that same day. So you would actually take possession once we have confirmation of the recorded documents with the local county. Now, you might be in a state like California where you sign one day and then we close the next day. It just depends on the area of the country that you're going to be purchasing. But as soon as we get that confirmation that everything is confirmed as recorded, then we get a chance to make our favorite call of the day, which is to say, hey, congratulations, you did it. You're a new homeowner. Time to fire up your moving truck and get into your new house and celebrate the huge accomplishment. And so that's probably one of my favorite calls of the day that I get a chance to make. And it's just a huge, huge, huge celebration. Many of our relationships, like I said, start with classwork like this with our clients, and then ultimately kind of transition into consultations and then plans, and then ultimately the huge goal of homeownership. Our relationships don't stop there, though, with our clients. We have our aftercare program to kind of always monitoring what's happening with housing market activity for you to seize refinance opportunities, sending you tools like our HomeBot system to track your home equity, and at least doing annual check-ins to see kind of where you're at financially and just make sure that we're top of mind to help with anything that comes in the space of your home and make sure that we can help support you. Well, as we wrap up tonight's class, I just want to kind of share with you how you can move forward in the process. If you'd like to be able to get connected with me for your free consultation, I've provided all the links here, online application, some of the documents you would generally upload. And again, this is just a soft credit check, so you don't have to be worried about impacting your credit score. Once you've done those first 2 activities, then you would just schedule your consultation, which is like a 30-minute session that we'll do. It's very interactive. We're doing screen sharing. We're doing budget analysis, savings plans, credit analysis. All of that's happening within that consultation process. Most lenders do not take this time and energy to do that with clients. It's more of just, here's your pre-approval, go out and find a home. We really value the relationship and the educational side of the home buying process with our clients. And so we want to make sure that you have everything at your disposal to make a really great financial decision. Now, obviously, classes like this can help, but I think that's one part of the overall equation for you in homeownership. This is what our consultative process looks like. So it's very similar to our classes. So we're going to do a very comprehensive analysis for you. You can start the process via mobile or desktop. We really try to embrace technology in our process for clients, whether that's, doing some of our AI work with some of our product development, or, just trying to stay connected better, whether that's through technology. But it doesn't replace the human touch of what we do for our clients. So whether that's calling to talk about something, or a text or an email, we want to make sure that we're connected with you to help you on this journey. Last thing I wanted to point out to you is just our discount as part of the KU alum family. We do discount our services for you, as well as providing you access to first-time buyer programs. And you're always more than welcome to attend our free classes that we have throughout the year. I got a chance to be out in Lawrence just a couple months ago, and during the basketball season, we got a chance to celebrate a big win against the University of Arizona. I know basketball season wasn't what we thought it would be, but hopefully we'll have a good one next year. But it was really fun to be a part of the energy at the field house and see everything that happens, and really felt good to be a part of the KU community and be on campus and see what's happening. So, we're excited to be a partner with you and on this journey. And I do appreciate your time and energy you guys brought to class tonight. If you like to share this information with other friends, family, or coworkers, I do teach other classes like this throughout the year. We'll teach over 10,000 people in homeownership this year through other partnerships also that we have too. So feel free to check us out for some of our upcoming classes that we have available to you. This is all of my contact information, so feel free to reach out to me with any questions you have. If you'd like to follow us in some of our socials, we try to put out good content for our communities. We like to just celebrate what's happening in our local communities as well. And you hear a lot about us in Reddit communities and on Instagram and stuff like that, but we really want to make sure that we're celebrating, but providing value out to our local communities that we serve across the country. With that said, I do appreciate everybody joining tonight's class. I got a few minutes before the top of the hour. Thank you so much for attending tonight's class, but I want to make sure I address any questions from the audience before we sign off tonight. Any questions I can help for our class tonight? Okay. Unless somebody is typing away there, I think we're good on questions. Thank you so much for being participating in tonight's class. Oh, I think I got what? Oh, so thanks, Jason. Okay, you're welcome. Thank you for that. You're welcome. You're welcome as well. Thank you so much for being a participant in tonight's class. I look forward to hopefully seeing you guys soon at an upcoming consultation at some point. Feel free to reach out to me if there's anything I can do for you. Have a good night.